Welcome to Nasdaq Trade Talks. I'm your host, Jill Malandrino, global markets reporter at Nasdaq. Joining me at the market site in Times Square, Joe Cusick is back with us. He's vice president and portfolio strategist over at Calamos Investments. We're going to take a look at capturing as much upside as possible, but with some downside protection on. Very relevant, Joe, as we're looking at the major averages, either at all-time highs or within 1% of all-time highs. Yep. And with that, there are some challenges and opportunities that you're watching as we round out Q4 here.
Yeah, I mean, the biggest challenge is how do you protect what you've already made, right? And right now, every conversation that we've been having with our clients and just in general is, how can I get protection in there but still capture the upside? I mean, people don't want to pay for insurance, right? That makes sense. So we try to do our overlay strategy that accomplishes that, so that when you look at it on a risk-adjusted basis, you know, going forward, you're going to say, this really makes a lot of sense. It's going to meet my goals down the road.
All right, let's pull up our first chart here. Sure. Now, this is a Calamos hedged equity fund, yep. And this is exactly what you were talking about here, these strategies that you have in place right. to limit that downside. What are we looking at? Yeah,
so what you're looking at is basically from the inception of the hedged equity fund, that's our $250 million fund that uses an overlay. We have the shaded area, that's the performance on the downside. So you see lower dips, quicker rebounds. That's how you want this to react. You want to protect on the downside. The blue line is the S&P 500. The orange line is the SIBO Collar Index. The Nasdaq is actually coming out with some innovative products that are going to mirror this as well. So it's interesting. You see that you want to keep those drawdowns really shallow comparative to the general market, and you want the rebounds to be quicker. And how you do that is use puts on the downside, and we're selling calls on the upside. That mitigates the cost of insurance and allows us to have that quicker rebound, so that when our core portfolio responds to the upside move, we're capturing that, but we didn't have to participate on the downside.
All right, let's move along to our next chart here. Let's talk a little macro. Now, the theme certainly has been slowing, but growing. It doesn't appear as if there's a near-term recession. That risk is relatively low, but there is a little bit of slowdown here.
Yeah, I wanted to show this because you've heard the recession word for the last 3 to 4 weeks consistently. But when you look at the LEI, it's not signaling recession. You're seeing it up around that 110 level. That's important because the last time that we've seen recession-like situations, right, you're seeing it get down into that 70, 60 level where you saw in 09, you saw it back in basically 98, late 89, 90, and also in 2000. So we're not seeing that, right? The leading economic indicators are still strong, which means that this explains the regime that we're in as far as volatility, where it's relatively low. We're not having big moves, even though we have a global slowdown here in the United States, very robust, right? So that's why we're not seeing either on a short term or in the, let's say, next year or two, that kind of recessionary type of situation where we'd have to think about repositioning.
All right, now speaking of global, to wrap up here with our last chart, of course we have to talk about China here, right? And you know what, they are continuing to invest in stimulus programs around technology, infrastructure, and housing, and traditional infrastructure. Right. What does this chart signal to you?
You know, a bit of a pause, right? And I think this is why you're seeing markets look at the tariff situation and the negotiations. Watch the APEC meeting in Chile in November. Starts on November 11th through the 17th. That's where actually Presidents Xi and Trump are going to meet. We want to see phase 1 signed in. If phase 1 gets signed in, you could actually see the green line is China. We need that to be tilting up a little bit more. It's starting to flatten out. If all the stimulus that they're doing, which is positive, it's going to keep this in motion like every other central bank. If that starts to flatten out or come down, that's going to be a little bit of a red flag, not more than a little bit. It's going to be a red flag. We want to start seeing that trajectory moving to the upside. So we're going to watch that, but watch that meeting. That is going to be the meeting to watch.
Because the thing is, even if we do get phase 1 through, I would imagine that is where the obvious changes need to be made, right? It sounds like phase 2 and phase 3, that's where the complicated negotiations get into. And it seems like phase 1 wasn't that easy to figure out. So phase 2 and 3 could throw some volatility back into the market for that reason.
Absolutely. You want to see pen on paper. You want to see that moving forward. You want to see actual implementation. That's going to be positive for the markets and positive for the U.S. because right now we're strong. The consumer's still strong. We still see great consumer numbers versus what we see in China. That will help China. That could get the consumer numbers back up on the right end.
All right, Joe, great to have you with us in New York as always. And thank you for joining me on Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq.